I really am. And, one of the things that gives me confidence is that I think there is very little upside to this market, even if everything goes perfectly. And let me kind of speak to that. We're in a new world right now. If you look at the average Fed funds rate over the last 20 years, it's 1.4%. We're now at 5%, which is about pretty close to, or about to get to 5%, which is pretty close to a 20-year high. Real yields are 1.75%. That's a 14-year high. The 10-year yield's well above average. And yet PE multiples should be lower than average, but instead they're trading at 17 times. So if you're bullish on the market, you have to assume that either earnings estimates need to go up, or you need to bet that the earnings multiple is going to go up. In terms of earnings estimates, the chance that they go up from here is extraordinarily unlikely, okay? And I think most people would agree with that. And then in terms of the multiple, I would ask, what is the argument for a higher multiple than 17 times, considering we're close to peakish earnings and based on what I just said, that rates are now at well above their 20-year average and in many cases 20-year highs. So I see no argument for the upside, and I can make plenty of arguments that we can go into around why the market should be materially lower. So from a risk-reward perspective, being short right here, extremely attractive.
I hear you, and it's like the reasons to be negative, as Leon Cooperman expressed not 10 minutes ago, are obvious and plentiful. And everybody's negative. And generally speaking, things don't generally go with the herd. Maybe sometimes they do for a short period of time, but they tend to reverse themselves at a time. How about that just in and of itself, that it's so obvious that maybe it's not that obvious?
Sure. So I think that's a great question and a great point. So I think what he said, that everyone talking very negative is very clear, certainly amongst the institutional community. But I think he also said that he was still 90% invested. And I think that if you look at what the retail community has done, they put $1.5 trillion into equities post-COVID, and they've sold probably about $100 billion. So they haven't sold yet. Then you look at the hedge fund community. Their net long exposure is below average, but still running 30 to 40% net long. So it's not what people say, it's what people do. And we haven't seen a bear market other than the couple months of COVID in 14 years. People are not adjusting and are not used to the fact that there could be significant downside to this market. So there's a sense of complacency. So my broad point is that there is a difference between what people are saying and how they are positioned. And I think that's a big deal.
What changes your view then?
I mean, honestly, at these prices, nothing can change it. What I would say is that let's say we go to 3,500. Okay, then it becomes more challenging, where you could say, oh, I could have, if I'm short, the upside could be, something greater where you could potentially get hurt. But at 3,800, 3,850 in the S&P, it's very, very difficult to make a case for higher prices than here. And I think people talk about these generalities of inflation's falling, the Fed is close to being done, we could have a soft landing. I would say, okay, great. So let's say that all happens. What multiple do you want to put on the earnings? And what are your earnings estimates for 2023? And I think it's very difficult to argue for either one of those to go up. And that's what stock prices are based on.